accounting equation and Excel reversing entry related to breaking out the short-term and long-term portion of loan payable liabilities. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation with Excel. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you could begin back there, but it's kind of way back at this point in time. So you might just want to create your own worksheet as we go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook though, 5 tabs down below. Example, in essence, the answer key, month 1, first month of operations, month 2, second month of operations, practice tab, having pre-formatted cells so you can practice the practice problem with less Excel formatting, the ADJ and reversing tab, the one where we started with a blank worksheet, the one that we will be working in, but now we're basically working with a template at this time. However, we will be adding to that template as needed as we go, practicing our Excel skills and formatting tools as we do so. Let's go to that example tab, getting an idea of what we're going to be doing. Remembering we're basically building the bookkeeping system using the accounting equation as, in essence, our trial balance from which we can construct and have constructed our major financial statement reports, balance sheet, income statement, statement of equity. So thus far, entered 1 month of operations. We then did the closing process, entered the second month of operations. Then we created our adjusting entry worksheet as of what we are imagining to be our cutoff date, which is usually the end of the year for adjusting entries for a year's worth of information, or possibly monthly, depending on the circumstance. But for our case, it's for the 2 months ended 2/28, so the end of the second month. Now, typically, we want to keep in our mind the distinction between what we're doing for the accounting and bookkeeping versus what we're doing for the adjusting process. They're similar, but not the same, because the accounting and bookkeeping wants to communicate with the customers as clearly as possible, as well as employees and vendors, as well as automate the system to the point that they can, so that the accounting is not taking up too much time, because the time should be spent making and earning revenue. Whereas on the adjusting side of things, we want to make the financial statements as close to the accounting basis being used as possible, whether that be the accrual basis or possibly a tax basis as well, because we have the needs at the end of the year typically for at least tax preparation and possibly for external reporting for things like the bank and investors and shareholders or whatever we need to be doing with it. So typically I would take the information from the accounting software, possibly, even if I have access to it, put it into a worksheet, usually using debits and credits, but using the accounting equation here so that I can have a transparent worksheet showing me what the bookkeeping department has, or the accounting department, versus our adjusting entries versus our tax entries, to see everything in one place. Once we do the adjusting entries, then the question is, do we want to put that back into the accounting system so that the system for QuickBooks or whatever software is up to date as of that point in time? Now, if we do that, then of course, we're going to run into some problems. One is the fact that we have the subledgers that we have to deal with, which we have discussed. And the other is that the accounting department is trying to achieve their goals that are different than our goals, and we don't want to mess them up. We want to make it as easy for them to communicate with who they have to communicate with, as well as record the information with as much automation, possibly using bank feeds, as possible. So keeping that in mind, we're now looking at the reversing entry for the short-term and long-term loans. Let me just go to the adjusting and reversing tab over here, and let's just see where we had that transaction. So here it is right here. So the adjusting for the loan, let's make this a new color. So I'm running low on colors. Let's make it purple. Make it purple. All right. So you will recall that when we're thinking about these loan payables, what I would think about is that's going to be a liability account. We're typically going to get a loan from the bank, possibly when we're starting the business, because we need money to then invest in the business, which can't come from customers because we're a new business. We need the startup capital, cash, right? Which is going to be coming from the bank or from the owner, right? So we might take out a loan from the bank, or we might be purchasing equipment, and at the time we're purchasing the equipment, we might take a loan out using the equipment as collateral, similarly to when people purchase a car, for example, and might be taking out a loan in that instance. So in that case, it depends on what industry you are in as to how many loans might be taken out. You might say, well, why would you take out multiple loans? Why don't you just take out one big loan and then do what you need to do with it, and then hopefully you'll be generating revenue and you won't have to take out any other loans. But some businesses, such as construction companies and whatnot, might be very tight all the time on their cash flow because they're investing as much as they can into the equipment that's being used to generate the revenue. So in that case, when they buy equipment, for example, you might be using that particular piece of equipment as collateral on a bunch of loans in a similar way as when you buy a car and you're using the car as collateral to help give you the loan. So that means that you could have a situation where you have a bunch of loans, and in that situation, remember, the idea would be, I want to make it as easy on the bookkeeping side as possible and as automated as possible. So I would suggest then making one account per loan as opposed to having a short-term and a long-term portion per loan, or as opposed to grouping all the loans into one account and then having the subledgers giving you the backup data or detail to it. Because if you have one account per loan, then you can check the loan balance as you go to see if it ties out to what is on to what the bank says or whoever you took the loan from as you make the payments. So that is going to be the easiest thing to do on the accounting side. I usually make it as a current liability because it's likely if you have an installment loan, loans similar to like a mortgage, for example, that are paid in monthly installments, that there will always be a short-term portion, but there might not always be a long-term portion because you might be at the end of the loan. There might only be a short-term portion, in which case you don't need to do an adjusting entry for that particular loan. Now, a couple other things just to keep in mind here. When you add a loan for like a QuickBooks system, you might actually put the name of the institution that gave you the loan or possibly the last four digits of the loan number in the account title, helping you to then distinguish one loan from the other. Note that those things are not things that you typically want for normal external reporting purposes. It might not make a difference for taxes, but if you're reporting like on an accrual basis for financial statements, for example, you don't typically want account numbers in your loan balances and whatnot, right? You just want one account called the short-term portion of all of the loans and one account for the long-term portion of all of the loans. Now you can kind of fix that to some degree in software by basically having a parent account in like QuickBooks, for example, and make sub-accounts so that you can print reports that have detail and reports that would collapse into one parent account. And software like Xero is even more flexible, allowing you to group accounts together and name them in that way. So that's one thing we want to basically keep in mind. Also, remember that when we do the financial statements, typically, if they were external reporting to like a bank or investors, we do only want one account for all of the loans, short-term and long-term portion, rather than having a separate account for each individual loan, which results in a balance sheet that's going to be much longer. Again, you can kind of accomplish that within software with that grouping technique. So then we have the problem of breaking out the short-term and long-term portion of loan payments. So remember that's going to be an issue if we look at the amortization table over here. And if we go to the amortization, this is a normal installment loan. So what the idea here is going to be, well, if the loan balance is currently at the $69,878, we're going to make 12 payments of $1,359. Current liabilities by definition are those that are due within a year, within 12 months. So you would think the short-term portion would be the $1,359 times 12. But no, because that amount includes the interest. So that means that for us to break out the short-term portion, we have to take out the interest of the payments, which means you have to have an amortization table, which means that if the bank didn't give you one because they may not be required to do so, you can create one either in Excel or have your CPA firm create one or find a software online to create the amortization schedule so that you can look at just the loan reduction amount, which will be the short-term portion of the loan. So that means that after a year, we're going to still owe $56,770. That then is the long-term portion, the amount that we're still going to have to pay after we've made a year's worth of payments of $1,359 after we take out the interest portion, just looking at the loan reduction amount. So this is the breakout that we needed to make. So one more thing, however, just want to reiterate the idea that when you make loan payments on a loan, you're going to have to break out the interest and principal, and you can't automate the payment because the interest and principal breakout will be different with each loan payment. So how could you automate it then more easily? Well, you might just say, hey, look, on my accounting side of things, I'm just going to let the cash go through the bank feeds and record the balance to one account, which will be loan payable, which means that you will be not recording interest, which will be wrong, but the idea is we're just going to make that automated and then tell our accountant at the end of the year or ourselves at the end of the year, I need to shore up the loan balance, breaking out the expense portion using the amortization table. So that makes it a little bit easier, once again, achieving the goals of both sides, making as automated as possible on the accounting side and then just doing the adjustment at the end to make it correct for financial statement reporting. Just want to point that out. One other thing I want to point out that we talked about before, but I just want to reiterate also that many of these loans might be put on the books in conjunction with the purchase of equipment. Purchasing equipment might be tied to as well the trade-in of old equipment, like a trade-in of a car or something like that, which means the transaction to put the loan on the books is starting to get quite complex because it comes along also with the recording of a new piece of equipment, which possibly has a deposit and possibly a trade-in, which means you have to take an old piece of equipment off the books. So typically, in that case, you would have to call the CPA firm or something, or whoever's doing the taxes, generate the depreciation schedule so you can record at least the trade-in properly, which might, even if they give you that information, it might not be perfect because usually the depreciation schedules are on a yearly basis. So you'd have to say, okay, in the middle of the year, how much depreciation was calculated at that point in time, and so on and so forth. So it's almost easier then on the bookkeeping side to say, hey, look, I'm just going to record the amount when I buy the equipment that I deposit for the equipment in as the fixed asset. The fixed asset's going to go up by the deposit amount, not the purchase price, because I'm going to remain on a cash-based system. I'm not going to record the loan at all because I didn't get any money for that particular loan. I used it to buy the equipment. And then I'm going to record the loan payments as a reduction to the loan. So the loan is going to be a liability account that actually has a negative liability number in it because I can do that easily with the bank feeds. And then again, at the end of the year, I'm going to ask my CPA firm to not only break out the short-term and long-term portion of the loan, but record the loan according to the purchase documents I have, according to the trade-in, according to the depreciation schedules, which they now have at the end of the year, and with the help and use of tax software that is up to date if they're doing it at the end of the year, because there's going to be updates to the tax software as the tax code changes and whatnot. So it's almost easier to just do that, to just do the whole recording of the transaction at the end of the year. So I just want to point that out, because if you don't do that, the tax preparer is probably going to have to reverse it anyways. So it kind of depends on the size of the company and what kind of mid-year reporting you need to do. But if you're a smaller business and you work with a CPA firm, you might want to say, hey, look, I'm trying to stay on a cash basis as much as possible. And that will make it easier to do that. And then you can basically have the CPA firm or tax preparer shore up all of the purchases, all of the trade-ins, all of the short-term and long-term breakout, all of the interest portion versus the principal on a yearly basis. All right, just pointing that out. But we just broke out the short-term and long-term. So if I go all the way to the left now, you can see that we have in our loan payable, we've got the long-term broken out, and then here's the other loan. Now we have two loans. This loan didn't have any long-term portion, so we didn't break out a long-term portion. This loan had a short-term and long-term portion, so we've got the short-term here and the long-term here. If I select both of those, that adds up to the total loan balance of the 68,878 that we would see in the amortization table. Now I'm just going to reverse it, taking the long-term portion out, putting it back over here. Note that if I do not do this, it's going to totally mess up the accounting department if they're trying to follow the amortization table, because when they make the next payment, they're not going to be able to tie in the loan balance to the amortization table, or to, the loan balance in our system to the bank's loan balance, or to the amortization table, because they'll have to add these two accounts up in order to do that. And it's just going to be messy, because to have these two correct, they would have to then break out the proper portion of short-term versus long-term each time. So that just doesn't really make sense. It's a lot easier to just, and if you had a lot of loans, by the way, then it gets really ugly, because now if you had like 5 loans, you'd have 5 short-term portions and then 5 long-term portions, and that's just tedious to look at. So we're going to recombine them together to make it easy on the eyes of the accounting department. So we're going to say, all right, this is going to happen on 3/1, and we'll make this purple, and we're going to reverse short-term, long-term portion of loan balances. Hopefully I spelled that somewhat decently. And then I'm just going to say the transaction that we did last time is going to be equal to the short-term and long. I can break out the whole thing. I could just say, let's do the whole thing. I'll copy this whole bit down. So we had short-term, and then I'll just copy that this way, and then down here. So there's the short-term and long-term we broke out from the amortization table. So together, the total balance was at that 69,878. It was all in the short term. So the journal entry was this 56,770 that we broke out. So let's go back on over here, and I'm just going to say, all right, I'll just reverse that now then. That's easy to do. So I'm just going to add it back in here. So I'm going to say this equals the 56,770, and this is going to be negative of the 56,770. Let's put some zeros across the board, por favor, if you please. It's not, you can't rhyme by using multiple languages. That's cheating. Whatever, dude, you can do that. If you can't find a rhyme, you just go to another language, but no one knows what you're saying. I don't care. No one knows what people say anyways in a song. You can't even tell what people are singing, whatever. So let's put an underline under this. Let's put an underline under this. And we're going to go to the Home tab, Font Group, Underline. And we'll bring down the balance to see if we're still in balance. Bring it down. Bring down the balance, baby. There it is. Boom. All right. Well done, darling. All right, now I'm going to get in trouble. Okay. So we're still in balance. So notice nothing happened here. Why? Because one liability went up, one liability went down. Remembering that this is not a classic kind of adjusting entry, because there's no timing difference involved. There's no income statement item, in other words. But it still has the same concept of an adjusting entry, because we're still achieving the goals of the accounting department being different than the year-end transaction department. I just want to point out before I forget also that if you're a small business, and you just need this for taxes, at the end of the year, you might not have to break out the short-term and long-term portion. I don't know if I mentioned that already, but it's because it's a balance sheet item, and you're only going to be reporting a Schedule C, which is in essence the income statement. So it's only if you were doing external reporting for like the bank, possibly for a loan, or to stockholders, or to investors, partners, or something, or possibly for internal reporting needs, that you would need to be breaking out the short-term and long-term portion typically. So just something to keep in mind. Some of these items, if you're a small business on these adjusting and reversing entries, you might be able to not, it might be easier. You might not have to do it, even though the concept is what you would want to do to have the most accurate reporting of the financial statements as of the cutoff date. But you might not need the most accurate reporting because there's always a trade-off between more information and the cost of getting the more information, right? So we're trying to balance those two things out. Anyways, I'm going to paste it formulas only. And let's bring down the balance, bring down the signs. Okay, we'll bring down the signs. All right. So now we're still in balance over here. Boom. In balance. All right. So now we're back to this one loan that has the 69,878 in it. The long-term portion has gone away. So the 69,878 should tie out to what's in the amortization table. So now when they make their next payment, they're gonna be right here, 69,878. The next payment will be right here, and they'll be able to move on nice and cleanly. Notice that if that's the idea. That's the idea. All right, is there anything else I should probably do a spell check. I think that's the last one. Let's just check our numbers real quick just to show you where we're at. This is where we're at. No adjusting or reversing entries to cash typically, because that's pretty much solid with the creation of the bank reconciliation. It's not timing difference related, which are what we typically do with the adjusting and reversing entries, timing differences. So here's what we have thus far, and I think this is it. This is like what we've got, man. This is where it is. So now on the income statement, we've got these balances which are hanging out there, which are kind of ugly because they're going the wrong way, but it's possibly the easiest way to account for the two objectives to not mess up the accounting department. So we still have to explain to the accounting department. They're going to be like, why are these numbers in my income statement before I've done anything for the entire year? That doesn't make any sense. We have to explain that. We're ready for that conversation on what the pros and the cons are, and we believe that we have the best system put together, and we're open to hear any suggestions otherwise. But and so we're good to go. That's how we got it.